Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Okay, today we are back to our coverage of the top 5 in the S&P 500. We're looking at Alphabet Incorporated today, known to you and me as Google. I missed you guys last week because I was sick, unfortunately. So next week we'll be probably looking at Apple, and then the week after we'll be looking at Amazon, and then we'll be back to Tesla again and running through the big 5 again over the following month or so. So without further ado, let's get underway. I want to start with the classical analysis first, and then we'll look at the primary count, which is bullish, and then we'll look at an alternative, and then we'll consider another one as well after that. So let's just turn off the counts first, and let's just have a look at what we've actually done thus far. So two things that stick out to me, and why I'm primary bullish at the moment, is we've come back to the golden ratio from the March 20 low, 61.8 and 65, back into this volume node here. Now we may have pierced it, and that's often a sign of weakness. However, we have bounced to a swing high off of it. We've had a high, a higher low, and another higher high. Now it could be 3 waves complete in a correction before coming down again. That's definitely possible. But it could also be 1, 2, 1, 2. And we're into another correction here and a potential buying opportunity. Now, after coming back to the golden zone, and if we bring up our exponential moving averages, we can see the most influential long-term moving average we have, which is the 250 on the weekly time frame, has coupled itself with the golden zone here and these two lows, this low and this higher low. So we've come back into major support. That support was also horizontal support, which we can see if we bring up our support and resistance folder here at 85.17. Essentially this prior high and 1, 2, 3, 4 or so lows here, which was back tested. So we had a high, move up, back test of these lows, and then we moved higher. So if we bring up our FRVPs here, we can see that we've got our visual range volume profile here. We came back into this volume node, so we know, but that's accumulated volume here as well. If we just look at the run up to the high, and we bring up our FRVPs here, we can see that here's our little node of volume, okay, which is this little area here. We have a much stronger area of volume down here, and we have a overlapping point of control down here, 3 points of control. So we've got a long-term FRVP from back earlier on. We've got our visual range as well, which we're working with, and we've also got this point of control here as well. So this is still a major area of support if we were to come down any lower. We did come into a little demand zone here. We can see a move up and a pull back and buyers, a move up and a pull back and buyers, a move up and a pull back and buyers, creating a floor, this horizontal resistance. So there was plenty of demand here, and off we moved higher. So essentially we've come back to the first real place we could from the high after this huge run up in 2020 and through 2021. So we first came down to the 60, as you can see here, which was testing, providing support temporarily. There's no real horizontal support or demand in here to speak of at all, just bouncing off the 60 EMA. That eventually broke, and then we came into some actual demand here, a little bit of demand and some actual horizontal support, which stabilized the market for a fair while, and then we thrust down to the 250 and the golden zone and this demand zone here. So we could continue this step down, right, or we may have bottomed here. So having a move off of the low, a move to a higher low, and another move to a higher high, just as we had here. That's the first potential you've got of 1 and 2 off of any low. Now this did not materialize here. It never really looked like it because this didn't look impulsive, and neither did this. But however, the move off of the low can be interpreted as impulsive. So that's the first possibility here of 1 into 2 at this lower low. That's the first opportunity buyers had. And they may have ended up trading a C if they were using my standard trade setup of 5 and 3. And then the initial reaction after that, they may have ended up trading a C, in which case they've had opportunity to move their stop into profit and protect themselves prior to a collapse. However, if this is 1 into 2 and 1 into 2, they will get an opportunity to add to their long position, okay, and make further profits going into a 1 into 2 into 3. So back at demand, back at horizontal support, back at the 250 weekly exponential moving average, and back at the golden zone. So lots of reasons to feel that the market's found support. Okay, so now I want to look at some geometry, long term and short term. We're going to come back before the 2020 COVID low for a minute, and I just want to share with you the longer term simple count. Okay, this is 1 and 2, this is 1 and 2. All of this is an extended 3 into 4 into 5 into 3 into 4. Now I'm feeling that this is more likely cycle wave degree correction, since we've come back to the 250 weekly average, which you can see has been major support once we're above it. There is the argument, and it can be counted. Now it's just something that's going to stay on the table until it's no longer a possibility, and it may stay on the table indefinitely, which is I've been too conservative with this 3, and we're actually at primary degree here, and this is 3, and we're down into 4. There's also the possibility that this is 1 into 2 of a larger fifth, and we're going to explode higher in a 3. All of those things on the long term are possible. Just looking at the geometry for a moment though, if I take that primary pitchfork pivot off of this 1 and 2, my suspicion is that this is a larger degree correction. And let me show you why. If we just zoom into here again, and we bring up that primary pitchfork, we can see how not desperately, but how hard the market tried to hold on to this thing. So tests of the 61.8 here, we move to the median line and the 60 exponential moving average. Median line, median line, median line, median line, bounce 50 through the median line, edge of the pitchfork, 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 bounce 50 again, collapse, breaking the primary bounds of this pitchfork. Okay, that is not always the case that an impulse wave stays within that primary pivot of the 1 and the 2. It can get to extreme levels. That's why we have the outer bounds of the pitchfork. But normally, more often than not, with the exception of dealing with the underthrow of a wave free extension, which we've accounted for here, you tend to stay within this primary structure, as you do within cycle wave degree and super cycle wave degree. If you wrap everything around those primary pivots, or dominant pivots, you tend to stay within them going forward in the pitchfork. So we broke all of those levels and we came back to the 250, which we haven't done for a significant amount of time, and we haven't really breached it since all the way back in post GFC time. So it's been a while, in other words. Now if we turn that off and we have a look at the cycle degree pitchfork, we can see that we have at the top side, let's just bring up the primary again, we have this little zone where we're trapped between 2 wave degrees of influence in terms of on a geometry point of view. So we have the cycle degree creating resistance, having come back. See how this was support? This is the upper bound of that cycle degree pitchfork. That's how strong that larger wave 3 was, how massively exponential Google's growth has been. Right, so we tested it for support here, came back here, fell under it, and it became resistance. These 2 lines, and it's quite... Oh, excuse me, let me just beg your pardon. Sorry about that. I normally leave the thing on silent. I don't know why I've left that like that. Let's turn it on silent now. There we go. Right, sorry about that. So what we can see how here, if we just change these 2 naked pitchforks for a moment, we can always change them back. Right, you change that to the wrong one. No, I don't want it in with the lines. I want it to... there it is. Median only. Now you can see how these 2 areas that cross over one another. Here's the resistance. Here's the support. How freaky is that? The same back here. Right, now these 2 larger wave degree forks, primary and cycle degree, this is all in log scale by the way, primary and cycle degree, constantly interacting with one another over decades now. So I just found that a little curiosity that I found quite interesting. But anyway, let's come back to the cycle wave degree fork for a moment, as we can see that we've come to the 38.2 diagonal line going from low to high. Right, and we've bounced, bump, to the 61.8, bump, down. We know this is horizontal resistance and this is horizontal support. We know this is the 61.8 as well on a smaller time frame. So at a cycle degree, on the larger time frame, you could argue that we've barely gotten started, right? You could argue that we've got a long way down to the median line here. And we also know that if we look at the FRVPs for a minute, here's our point of control. And if we look at, and this is right on the median line, if we also look at the fib retracement, this is also the 78.6. Right here, boom. Bang on that point of control, bang on that median line, right here on the cycle wave degree. So there is definitely still potential to just break down lower. Okay, but this is the problem when we go long term, shorter term. You know, what do you allow to dominate your thinking? I'm happy looking at both time frames, but my instincts tell me that if I see 5 off of a low and 3 back off of major support, and I consider the 61.8% golden zone and the 250 to be major support, I'm going to give it the benefit of the doubt of being 1 and 2. It could be A and B into C, in which case we can protect ourselves during the C before it rolls over, but I'm going to give it the benefit of being 1 and 2 because you don't want to miss the train, right? You don't want to miss getting on the next big choo-choo train, you know, and they'd be sat there waiting at the station forever. So I'd rather be long and be wrong, okay, than miss what could be 1, 2, 3. So it's just the way I'm built, and I'm happy taking that trade. And if I'm wrong, I get stopped out and I wait for another opportunity to give me the same again. Okay, and that might come. We don't know that. So anyway, that's the longer term degree, and I find those two little pitchforks, two massive pitchforks, and their interaction with one another in price very compelling. There's probably combinations of such in other places as well, but you just can't guarantee you'll always find them. Yeah, but we found a nice bit of confluence here in Google. Okay, so we've looked at the longer term. Now let's look at the shorter term for a moment using the same techniques for geometry. So I've got one pitchfork here that I find fits. Now it's a bit tricky because this is the intraday weekly high. This is where the highest price was set, but it's not where the highest close is. Highest closes are back here. Okay, so debate about whether or not this is some kind of swing high or whether this is the actual top. I've taken it as the top. Okay, just because I can't really get it to count well otherwise, but it could be some kind of new price extreme within a correction. But either way, I digress. Let's get back to the point. This kind of fits in both log and linear. We can see now we've been below this downward trend the whole time, bouncing around the major levels within this pitchfork. Let's come back to the daily for a minute so we can see a bit clearer. And if we look at it in linear as well, we can see it also works in linear, but it doesn't fit quite as well as it does in log. So make of that what you will. And then we've also got a simple regression channel. Right. So taking everything from the high, which we can now see on the daily time frame. Here's the close, right, was down here. The open, full body of the candle on the daily was above everything else, above intraday pricing. So it's just on the weekly basis that it looks very distorted. On the daily basis, that's a full-bodied candle up here with the opening price up here creating that intraday spike. It wasn't a daily spike. We didn't intraday spike and then come down with the body of the candle, right? You know, we didn't open here, rush up in a spike and then come down, right? We opened up here. That's the difference. So gotta give that the benefit of the doubt of being the top. Now from here we come down within the regression channel, taking the high to the low and projecting forward rather than consuming all of the current data, because the reason we go from the high to the low is it gives us an established trend of everything within that high to that low, within 2 standard deviations of the mean. Everything's contained within it. Now we could still be in a downward trend, but you could argue that the downward trend line from there has broken. Okay, so we go from Now if we do make another low, we push the regression channel along to consume all of the data to the new low, and then we'll see this trend will adjust to contain all of the price, including that new low. But for the meantime, we've got a high to a low, we've got a move up, and a move back, and a move again. So we're just giving it the benefit of saying, well, perhaps that was the completed correction, that was the completed channel. Just helps us get into our heads how the trend looks. So we can see that if that was the low, right, we've now come back to the median line and pushed higher with some resistance and some support around the edge of that trend line. Now we're selling off. We had a bit of a strong sell-off yesterday, so maybe we're coming back to test it. Just a possibility. So we'll leave the geometry there now. We'll just have a look at the indicators we've got. So turn that off. Long term on the daily time frame on the OBV, we can see that we're still arguably in a downtrend. We've got 3 points of contact and we had a rejection from it yesterday. Maybe we're going to come back and break through this. We did poke our nose above it, but it's only 2 points of contact prior, so it's not the strongest trend. Okay, but we did have rejection here at that trend line. Do we have one for the weekly time frame? Let's have a look at it in the weekly. This is the one for the weekly time frame. Here's slightly different. We've still only got 3.2 points of contact prior, rather than a true trend of 3, but we've broken that prior weekly high, so that's slightly different. Broken that weekly high here, and we've moved up, and now we're coming back to trend. So are we coming back to test here? Possible. I know we're talking about the ABV here, not talking about price, but I do find over years of observing it that we tend to see these negative and positive accumulations of volume tend to run until they're tired, you know, and then when trend reverses, we tend to break that downward accumulation of volume, or that positive upward accumulation of volume breaks when we're no longer bullish. You know, we saw the same with the break of the upward trend here. Right, so let's just turn that off. Coming into the lows on the weekly time frame in the RSI, we did have bullish divergence between the closes of these weekly lows here, here on the RSI, and here on the RSI, slightly higher lows. Same with the MACD, we had bullish divergence here, and we've had an increase in bullish momentum that's stronger than this prior first rally and stronger than this prior rally as well. Okay, signal back for the average and trending higher for the moment. Well, 1, 2, 3, we've got 2 highs, 1 more low and 1 more high. We'd be a bit more convincing, but we seem to have ended that downward bearish trend in the MACD. We've gone from overbought to oversold in the RSI on the weekly time frame, back to major support. So there's still every reason, while this low that we made remains in place, to be bullish. Essentially, we can always prepare for it not to be, but for as long as that pivot's intact back here, that's a presumed low. Right, so now let's move on and have a look at the Elliott wave count for the primary count as it is. So this is what I've got. Let's come down to the 4 hour, shall we? So from the high, we get a W, X and Y. Zigzag, zigzag. So 2 zigzags joined by an ABC. Here, zigzag here as well, and the X most common, but with a B wave expanded flat here within the A, and then the B, and then the C. So 5, 3, 5, and it's very typical looking in that regard. It does not alternate with the cycle wave degree 2 long time ago, which was also a sharp correction. Now it doesn't have to, but it's quite common, and it's normally what we expect to see. That opens up the possibility of something much bigger occurring. We'll touch on that before we go, but either way, that's how we get down to the low. From the low, let's come down to the hourly, and this is the best I can make of it. We have 5 waves up into an intermediate 1, that should be here. We have A, B, C, zigzag into a 2 down here, and then I'm trying to map this out as best as I can because this is the most recent price action. I've got 1, 2, 1, 2, 3, 4 extended fifth into minute 3, triangle A, B, C, D, E, 4 and 5 at minute degree. Can't see any of the fifth wave bar, maybe the last wave 4 here, as there's a big gap. Now the first priority was to come down and close it, and that's exactly what we did. Quite common. It depends how big the breakaway is. Your gaps often get filled, most of the time they do. Sometimes when the breakaway gap is huge, we might not fill it for a very long time. That's what we call a gap and go. So you get a level created between where the price action prior was, we gap above it, and rather than fill it, because it's just too big a gap to fill straight away, we just rush instead, and we won't fill a big gap like that until much later, months or even years later. Sometimes I've seen that occur. But this was only a small gap and there was plenty of time to fill it, so that's exactly what we did. Now this looks like 3 to me rather than 5. Okay, so I've had that as A as a 3. I'm looking at this as a zigzag for a B as well, and now I'm looking at 5 down. Big 1. Now it could be a 1's hidden inside the gap here, because that's all, sometimes you just miss it out. And we're going into 3, 4 and 5. But we haven't got price data to fill this, so I'd rather just assume that's going to be 1, 2, 3, 4 and 5 down into A, B and C for a flat pattern here. It could even be done. It just doesn't seem like it's particularly long, does it? So if we were looking at a retracement for the bulls to get in here, here's the 61.8 down here with the C and the 2. You could say W, X and Y, but expansive X waves in a double zigzag don't make much sense at all, and there doesn't appear to be an alternative explanation for it. So I think just looking at it as a flat for the meantime makes the most sense. The trend up to the high has broken, so if we just get ourselves, let's use a regression channel to signify that. So from the low to the high, right, we've just come back, broken that trend, so we should be moving lower now, unless this was already complete, in which case that was an extremely brief wave 2. Extremely brief. I mean, if we look at fib time for a moment, I'm not the biggest fan of it because I just don't find it to be that accurate, but we didn't even make it past the 23.6%, the length of this wave 1 to find our wave 2, so that would be extremely brief. Finding it down here, much more likely after the 23.6 onwards. So if we are correcting, it could be a flat, it could be something else. It's not easy to read at the moment, but coming back to 61.8%, 50 to 61.8%, settling down somewhere in here to get our wave 2. That's another opportunity for the bulls at that point, because we've now got 1, 2, 1, 2. If we go higher from here, and we've bottomed already, the likelihood of that being 2 is pretty low, so I would probably recount it. How exactly, I'm not sure. 1 into 2 maybe, and then this is 3 into 4 as a flat, and we push higher. It's a bit of a struggle. I'd have to rechange the subdivision here, but yeah, I'd be much happier now to see that come down lower. Find a deeper retracement between the 50 and the 78.6 or around the golden zone. Look for a reaction to a higher low, and then that's the best possible entry for a long trade to continue further. So that's how I see the shorter term. Well, we've got 1, 2, 1, 2. I'm going to continue to be bullish in the meantime, but let's always consider the alternatives. So let's gather that together for a moment, put that into the count, and what we'll also do is we'll just add in an invalidation point. So that idea of 1, 2, 1, 2 breaks down here and is no longer valid at this point. Now you can always play it both ways, right? You're not restricted to just waiting for this thing to make its mind up, right? Just as we say off of the low, if you see 5 up and 3 back, which breaks that prior trend, okay, we're looking to go long. If you see 5 down and 3 back, which breaks this prior trend, you could look to go short in the meantime. Right, you don't have to trade everything on a longer swing basis. You can trade it in a shorter time frame, can't you? So if we do come down in 5 here, that could be the C of a flat, and then we start to move higher. But if we don't come very far and we reverse back up, that's a lower high. That's an opportunity. I swear to God, I'm not doing this to annoy people. My phone's just out to get me today. Alright, so there's the possibility of 5 and 3 back, and you can trade this part of the correction. Okay, it's just an option. And then you've got the possibility of waiting for that long trade to come in. So we've had 5 up, A, B, C back. Right, you could be short, drawing this, waiting to get long off a reaction to go higher. Or you can just sit it out and wait to go long. It's totally up to you. Or you can just, if you're bearish and you think this is one larger A, B, C, then you should be viewing that as 1 and 2, and you'll be short to new lows. Okay, being flexible. So let's now consider the possibility of a more bearish count. So I put that in the wrong place. Bear with me, I'll get there in a moment. Put that in the correction folder. Save the damn chart before I forget. Right then, so a bearish outlook instead. So we've spoken about all the support we've got down here. That's all well and good, but what if it doesn't hold? If it doesn't hold, we know that there's much stronger support further down and a bunch of long-term geometry, including a major cycle wave median line, plus a 78.6, plus a major point of control, plus a major demand zone to hold us lower. So there's still possibility of going lower. And the way I would look at that is it just continues. Right, so we've had ABCW, ABCX, ABCY, that's exactly the same, except this now becomes another zigzag, ABCX, and now we get ABCY. Now this is in linear. If we shift into log, you can see this looks a bit better. I'm not necessarily saying we have to use that channel, but I've tried to frame it as though this is the best I can do between the high, these two X waves, and a further move lower. We have still moved out of this channel, essentially, but let's just expand it just a little bit to contain price. So maybe we move down as part of a larger triple zigzag. That triple zigzag can bring us into this prior demand. Okay, it can bring us into that long-term, that's channel, long-term cycle wave degree pitchfork onto that median. It can bring us into that 78.6% retracement here as well. It can bring us into all of that prior demand structure as well. So there you go. That's how I see the two most likely counts. We've either bottomed, and this is 1, 2, 1, 2, in which case we're bullish. We're coming off of the golden zone. We're coming off of the 250 exponential weekly moving average. We're coming off of a small demand zone. We've broken the downward trend. We're going to go higher. If we fall back below all of this, take out that invalidation point down here, which we saw in the count here at 84.87, then we're bearish, and this was 3 waves, and we're going lower in another 535. So there will be opportunities, even if you don't take it as short here or here. You know, there will be an opportunity here at some point into a B, into a C, to go short on a larger swing trade. So it's all to play for. I'm going to stay bullish while we're above those major pivots, while we're off that major support. If things break down considerably and stop looking right, and the corrections get stretched to the point where they're no longer believable, I'll probably turn bearish, but I'm just going to try and keep an open mind in the meantime. Now there's one final thing to consider. Okay, and that is how to get alternation at the cycle wave degree within our long-term geometry that we've built. Okay, using our long-term moving averages, long-term geometry to frame the market, and that is the possibility that we're actually going to get something much, much bigger. So instead of having another sharp like we've had here, we've just got WXY as A. We then get B, okay, to new highs, and then we then get C to new lows. Now let's just bring up that cycle channel for a moment. This is the idea that this cycle wave degree is not sufficient currently, and we need to actually do something like this, something really gigantic to fit in with the larger wave degree of alternation of sharp into sideways. Now this is not something that's worth worrying about, of course, because we've got to make new highs in the meantime, so it still says bullish. It still says to be bullish. Okay, because why miss that? Why miss a rally to new highs? It's just something that once we breach new highs, we want to be looking how we've got there. Did we get there? If this turns out to be 1, 2, 1, 2, 3, 4, 3, 4, 5, A, B, C, so it could be something like this. That's 3 to a new high. That's going to get us a little worried, because it could be 1, 2, 3. So that 3 could also be A, B, C to a B wave high, and then 5 down in a C. So observing, do we get an extension within the 3? Do we get volume coming in to support it? Is momentum much stronger in RSI and MACD? Is it selling as a 3 or is it selling as a C? Essentially is what we want to be observing if we come to new highs. And then we can be on guard as best as we can. But it's a bit like worrying about nuclear war. It could potentially be devastating, but it's always a long way off and it's never going to happen. So it's that's how it feels. It's one of those things where it's not going to be awful, but it would suck coming from $200, more than doubling from where we've got to here, more than 100% profit just to come all the way back to like 70, 80 or even lower potentially. So, but that's just a long-term consideration, so we shouldn't worry about that in the meantime, because it still calls for us to be bullish if it's correct. So to sum up, and I know I've gone on much longer than I intended, I seem to just make a habit of doing this. I am bullish. We have a low in place at the golden zone. We have a low in place at the 250 exponential moving average. We have a potential 1-2, 1-2. If that doesn't form another 1-2, doesn't give us an entry to the upside, and that pivot up the minor degree breaks, I'm going to be bearish again and assume that we've got another zigzag lower in the meantime. Alright then guys, thank you very much for joining me. If you're new to the channel and you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below, and as always, a huge thank you to my Patreon subscribers. Your support is greatly appreciated. I'll be announcing this week's live stream, I think, today. You'll get this video today, YouTube will get it on Friday, and we'll be having another live stream on Friday, so there you go. Alright then guys, take care, and I'll be with you probably next week now. All the best, bye bye.